All right, welcome everyone. Welcome to the Hurley Investments Trade Findings and Adjustments for the 16th today, and it is 2023. I've got some of Keith's notes from last week, and I'm going to spend a quick 20-25 minutes on decision making. So let's go over decision making really quickly, because that's what I'm trying to go through. And I guess, so the theme for today, decision making. Now this is supposed to be, this trade findings and adjustments are for those that were in the education that like to do some of their own trades. This is not the primary investing for Hurley Investments. This is just a little something extra we give you for those people that have gone through education and like trading options. We do not recommend that you do all these trading of options. In fact, if you are a member of the spread trade systems, the options animal, the safe option strategies, you'll find out they're going to tell you to call or trade 80% of their portfolio, and 5 to 8% of your portfolio should be used in these option spreads. So just keeping that in mind. Really, we're doing this because it's something you guys requested and something we enjoy doing, something we have fun with. But again, for most people, 80% of your portfolios in caller trades, 5 to 8, maybe 5 to 10% should be in some money-making opportunities and options. So with that said, anyone follow up on BABA today? Anyone know what's going with Alibaba? Yes, they beat on the top line, beat on the bottom line. In fact, they beat by 35 cents or so on the top line, the earnings per share. They beat by 300 million yen or whatever they live off of over there in China. But they also let everyone know they are suspending the iCloud due to US restrictions. US companies are not allowing, the US government is not allowing US companies to use the Alibaba cloud to store their company information in. So if we were to look at a chart, wrong one, let's bring it up. If we were to look at a chart on BABA, why would we say no trade? Why would we say no trade on a chart on BABA? Why would we say no trade on BABA? There's got to be something that distinguishes this. Why would we be saying no trade on BABA? Yeah, that's a tough question. It's a tough question because right now we have it sitting at its lows in the last month, pretty close to the lows in the last 6 months. We're getting support at 178, at 78.11 off of a support 1 level. which is just more or less the standard deviation from the previous price. So there's no consistency. There's no up, down. In fact, it might trade sideways. We don't have a trend. So when we're talking about how to trade, right? When we're talking about decision making, if you can't define a, how do I say it? If you can't define a probable trend, then don't force a trade. Jeff Hall, I see you're here. I believe you're from the Safe Option Strategies. Have you heard that one from Jeffrey Dunning in the past? If you can't define a probable trend, then don't force your trade. Don't make up a scenario. Don't make up in your head a reason. Use facts and data to suggest what you're going to do. So with that said, we've got last week's notes on Apple and Disney. If you were going to do a trade, would you have done the 90.95 Disney bull call or the 185-195 Apple bull call? Which one would you have done? Any thoughts? Apple. Lance, why would you have done Apple? What was your thought on Apple? Because obviously, earnings proved a lot of naysayers wrong with the iPhone sales are excellent. They did, I'm pretty sure they beat top and bottom line. Let me take a quick check on Apple. Apple beat top and bottom line. Of course, Apple is kind of funny. They beat on their iPhones. They were horrible on their Macs. They beat on their iPads. They missed on their wearables. They really beat on their services. And they really beat on gross margin, right? But why Apple? Because you should invest in Apple, not trade it. So you listen to Jim Cramer, and I personally don't like the man, or okay, so I don't like the show. I disagree with his returns and what he said he's done because I haven't seen it. But yes, Apple is one that most people should probably own, not trade. Today we're talking about trading. I don't know if I would have used that as a reason on which one to pick. But as Keeve and I spoke about this, I chose Disney. And I chose Disney, the 90.95 bull call. And there's a reason why I chose Disney. The reason why I chose Disney was because I felt it had more upside potential and opportunity. So my decision-making process, bull call, I wanted to go out till January monthly of 2024, and my cost basis was $1.95. So reasons: Christmas rally, higher upside potential. It's trading at what? 80 something, 88 when we talked about it last week. And it used to trade at 208. Apple, I think, is pretty close to their all-time highs at probably just under 200. Movies as a stock price boost. And I would go as far as to say movies, theme parks during holidays. I would also go 7 million more subscribers than expected. And it's not really true. I mean, they had 7 million. They were expecting only, 3 or something. Double the subscribers, new subscribers. If you look at a chart, I know it's easy to say, well, hey, Kevin, it's different now. But if you look at a chart on Disney, we were on the 11th. So we most likely were looking at Disney right here. 1, 2, 3, 4, 5. Actually, we were probably looking at Disney on that red candle, that down day. 5 business days. It would have been last week at this time. And so the thought process is, Kevin, how are you making a decision on a bullish trade on a down day? So that was the question, right? How the heck are you making a decision on a bullish trade on a down day in Disney? What was your thought process? And I'll tell you, 88 up to 91, my expectation is that Disney would not get past their 200 day. I thought the game plan was from $88 to 91, and you got out. Disney had good earnings, but not necessarily enough to break 200 day where you have a bunch of sell orders. Not really expected. So Kevin, why did you decide to do a 90.95 bull call on Disney on that big red candle? And it came down to a couple different reasons. A big sell day after a huge buy-in day. Good earnings. I could give it a couple weeks to go and move, letting it get through maybe the holiday season. I went out till January 2024. To make a long story short, on Monday, I just about closed my trade when it couldn't get above that 200 day. But then yesterday I closed my trade. Someone looking at this chart, why would yesterday be the day I would close a bull call that's only been open a week? It's only $195. It's not huge. But why would I close a bull call yesterday on Disney when I can go all the way out till January? And because they're not even through their Christmas time yet, someone tell me, why would I make the decision to close my bull call yesterday? So the candle is today. You can't count today, right? But Jeff Hall, perfect. At resistance, we're at that overbought RSI line. And that's an important indicator. That's probably one of the most important ones. It hit that resistance. If you go back in time, 95 is kind of the high. Hasn't got above 95. We already used a ton of buy orders to get over the 200 day. And I was really wishing my luck last Friday by letting it go one extra day, right? I guess last Wednesday. Today's Thursday, Wednesday, Tuesday. Last Tuesday, or this Tuesday of this week, last Tuesday, the smartest play would have been to close it because it usually doesn't break above the 200 day in one day. It takes time. It builds a base. It hits it 2 or 3 times. Technically speaking, it was in my best interest, and the probabilities were to close the Disney bull call on Tuesday. I was going to let it run one more day, but I ended up closing it yesterday. And Jeff, I'll answer those questions in just a second. I ended up closing it yesterday because technically I felt like I had made enough. Let's get this going. My order yesterday to close Disney, it was at a 62.26%. I could make $117.50 on a $195 investment. One of the reasons I really like this position, my risk was $1.95 to make the difference in strikes, which was $5, right? Minus the $1.95 I spent on the trade. So I had the ability to make roughly $3.05. A 2.5 to 1 risk to reward ratio. Excuse me, a 1.5. I can make 1.5 times my risk. It was really simple for me to make this decision. To close it yesterday, I already took the risk of staying one extra day. It was lucky to bounce above the 200 day in a single day. Time for me to close it down. Time for me to close down my trade so that I could book a profit. The decisions to get in were pretty easy. More upside potential, movies, theme parks, more subscribers. My decision, I got a better risk to reward ratio doing Disney instead of Apple. Easy to put on in a down day. Little scary when it's down around 88 and you're putting a 90, 95 bull call on. That's a great example of buying into weakness. Made a mistake, should have exited it with like a 20% return on Tuesday, but chose to let it go one extra day to prove that the 200 day was resistance. Went one extra day, closed it towards the end of the day, and walked away with a 60.26% return on roughly 4 market day trade. I guess it's 5 market days. Jeff, I do not have a membership at Stock Charts. I don't believe I need to spend the money to have the tools and their extra stuff. They're tools to draw charts. If you need tools to draw a chart, I would suggest you just run over to FinViz. FinViz does all the simple drawing of charts for you. So if I was to stick Disney in here, what FinViz does with their charting here is kind of what you're paying for the extra minus some newsletters on stock charts. Also remember, I'm not an options trader. I invest money in the stock market and do it for businesses. I do it for individuals. I'm not allowed to, for lack of a better term. I guess I could, but I'd run into some serious trouble if I was doing option trade people's accounts, because the SEC and the federal government feels that that is too risky for individuals, and they're probably right. Most people don't have the patience for the up and down. So very simple. You'll see how I set up my charts. It's all for a longer term thought process. I use the standard RSI MACD. I'd use the 50 and the 200-day simple moving averages. That's where you see anyone that's trading any real money, institutional money. No one ever uses an 80 or a 100-day simple moving average. No one that trades any real money ever follows the Dow. It's the S&P and the NASDAQ. I've got two additional in here that I like to use. I like to use pivot points. They show some possible support and resistance levels, but pivot points are not, nor should they be used for real decision making. Pivot points are short-term trades, 30 days. It's a day trading technique for pivot points, and in no way is it historically accurate. You're 50-50 on your pivot points acting as resistance and support. I do use the Williams %R. The Williams %R is a medium stochastics. It's an indicator for overbought, oversold by institutions. And so I use my Williams %R as an indicator to get into some positions that have some great upside opportunity. It's my biggest buy indicator is a low Williams %R, which obviously I abused and ignored on my trade I did for Disney. So Jeff, I hope that answers your questions for you. Why would we do no trade today? Big volume will end on Friday or Monday of next week, excuse me. I don't know when we'll do a rebalancing for portfolios because of the holidays of Thanksgiving, but I bet you would see some rebalancing before the holidays and some rebalancing after. So it's not a prudent time to be putting trades on. I would not be initiating a trade that would be directional this week or next week because of the holidays. Part of my decision-making process. Are there any other questions you guys have? The Williams %R is like a medium stochastics. It's not a slow, it's not a fast, it's kind of a medium one. It seems to fit in the middle. But for me, the Williams %R is the best way to see institutional money coming in and out. I'm not a big fan of on balance volume. I'm not a big fan of some of the other ones. I've used the Williams %R for forever. So it's just, yes, medium stochastics. It's something that I know that I've used for 4 years. And it is primarily my indicator for the Williams %R is my primary indicator to use to initiate a trade. I will look at the Williams %R, and anytime it gets oversold, that would be a big and red flag to say, or a green flag maybe, right? A green flag, if I see it down around here, And some of you will notice it when you see it down around here. That's one of my indicators when we've made money on the way down, that it's time to add another 100 shares. So those of you that are with me that I'm managing money for, you'll notice we added 100 shares of Disney here recently. And that indicator right there was the go. And I think we got it down here at like the $80 mark. So a nice, again, that's what the Williams percent R is for me. Oversold, definitely. Great time usually for covered calls. And you can just see you would have went through some heartburn here, but overall would have worked out very good. Right here would have worked out very good. Just touched it, would have worked out very good. Very good. And again, you would have went through a week of heartburn here, but would have worked out very good. So yes, overbought, great time for selling over short calls or adding protection. Down here at the bottom, oversold, entry point, usually a great entry point opportunity for the stocks that I follow. All right, any other questions? If not, I appreciate you guys being here. I hope this helps you with decision-making processes. I hope this gives you a little bit of understanding of where you use some technical analysis. Don't forget, technical analysis does not guarantee future results, but it is very interesting to use it and to work with it on any questions that people may have. That makes no sense. It's very interesting to use it on the herd mentality of what people's decisions are. So Jeff, when I say like a medium stochastics, I've seen fast and slow stochastics as an option for you. The Williams percent R seems to be in between those two. I would call it a medium stochastics type chart. You've got a bunch that you can choose from, right? Let me get this back to what I want. When you decide on what you're looking to use, you have fast and slow, full stochastics, stochastics to RSI. There's like a dozen different kind of stochastics that you can use. I believe the Williams percent R is a medium stochastic. It seems to fall in the middle of the slow and the fast. It seems to more accurately predict institutional buying and selling. So it's not a full, it's not a deviated, it's not a standard, it's not a slow, it's not a fast, it's not a stochastics RSI. It's a medium. It falls somewhere in the middle of a slow and a fast. And again, it's just my best opportunity that I use, and it's more accurate than on balance volume for institutional buying and selling. And again, I've used it for, geez, when I say forever, I've used it for forever. I even like it better than Bollinger Bands. So it's what I use because it's most comfortable for me. And that's it. Any other questions you guys have? Going once, going twice. Perfect. All right, guys. Hey, hopefully this was helpful. I will get this posted here this afternoon. And I hope past history is helping you guys with your future decisions that we're making. Hope this gives you a good idea of what we were doing and why. You know, $195 to collect 100 and probably what, 115, 112 and a half after fees, commissions. You know, it's an extra $100. It's something that we're doing for fun. It's not how I would invest a portfolio. Caller trades are where it's at. We're only doing this for those of you that have been through education that like to see a little extra on the side. This is your little extra. I hope you enjoy it. Guys, have a wonderful weekend. I will see you next Monday evening. Take care, and until then, be safe and trade wisely. Bye-bye.